You're listening to the 10 Bagger Podcast, presented by the Daily Gold. Join us as we uncover tomorrow's 10 baggers today. And now here's your host, Jordan Royburn.
Hey everybody, welcome back to the 10 Bagger Podcast. This is episode number 7, and I'm with a new guest, someone that I have not interviewed before. We actually just met for the first time talking about 10 baggers over the phone. His name is Durrett. You can find him at goldstockdata.com. It's a great website. You guys should definitely look at it, subscribe. And Don also has a great book, which he first put out in 2010, but he updates it every 2 years. The title is How to Invest in Gold and Silver, a complete guide with a focus on mining stocks. Don, it's great to have you on. I'm really looking forward to this. How are you today?
Oh, doing good. Thanks for having me on, Jordan.
So, Don, as we get started, maybe for those who are not entirely familiar with you or your background, why don't you tell us how you got involved in this sector and what led you to start your website and service?
Oh, two good questions. So I'm an old-time gold bug. I actually started back in 1991. But I started, I had no understanding of mining stocks, so all I did was mutual funds. And then in 2004, I started investing in juniors. And at the time, there was no silver mutual funds, and I wanted to invest in some silver miners. And the only way that I could do that was I had to learn how to analyze mining stocks. The first person who I came across was a guy named Jason Hommel, who had a silver mining stock, because I was after silver miners. And at the time, you had to pay $100 to look at his portfolio. So I paid $100. And what he did was he was doing a lot of optionality plays, and he was looking at buying silver very cheap in the ground. And that taught me that one thing that I learned was that you wanted to get a good entry price, because he focused on buying really cheap silver in the ground. So I've always had that mentality of focusing on getting a good entry price, buying really low, if you will, so you could get a 10 bagger. So I've always, the reason I got involved in gold and silver mining stocks is I was after big returns. I wasn't after, 25% annual returns or 100% return on an individual stock. I wanted to make 500% return on my entire portfolio. So I focused from day one. My ideal stock was a potential 5-bagger with 10-bagger potential. And when I wrote my book, I said in the introduction, I'm after basically a 500% average return. So that's where I was at. So that's how I got involved. I was always kind of a gold bug. I was always a believer in gold prices going much, much higher. Still am, never lost that focus. And I created my website because there wasn't anything out there. So I created a database of data. So I have 800 stocks in my database, and every single one of them, there's enough information for you to get a general idea. Plus, you get a lot of detailed information like resources they have, balance sheet, upside potential, a lot of good stuff. And that's why I wanted to come on your show, because you're educating people, and that's what I try to do with my website.
Yeah, I like how you say 5 baggers, because what I'm looking for, as I often say, I'm looking for stocks that can do 3x to 5x in maybe 18 months to 2 years. And the 5-bagger podcast, it just doesn't really hit the audience the way you say a 10-bagger podcast. So it's really, and I think you're the same way, looking for 5 baggers that have potential to be 10 baggers. So with that said, maybe you could share a 10 bagger or two that you've personally had over the years, and what you've learned what you've learned in your history, because you've been doing this, it sounds like, for almost 30 years. Share one or two winners that you've had along the way, and then what you've learned that you plan to use that's going to help you in the years going forward.
Yeah, that's kind of why I wanted to be on the podcast, is to kind of share that experience. It's really been 15 years. The first 15 years where I was just doing mutual funds, but 2004 to 2019 was juniors and exploration, development, production focused. Yeah. So just to share some experience. So one thing that I've learned along the way is that optionality plays and exploration stocks don't have a good risk reward. It's very, very difficult to find a 10-bagger, especially if you don't have a large bankroll or large portfolio, such as Eric's brought, where you can basically have a kind of a shotgun approach and just cover your bases, and then you're going to hit so many. But most people can't do that, and it's just too much risk. So you end up on the exploration side of things, or on your optionality side of things, you end up have to chase momentum. So what you end up doing is, the only way you can really kind of reduce your risk, if you will, is to wait until a company starts trending. And, very few stocks do that. And so once a stock starts trending, then you can jump on the trend, and then hopefully it'll go to a 10-bagger, and then you can put a stop loss in like at 20%. But I don't like to do that, because I just found that the risk reward just isn't there. And that's kind of a short term kind of focus on a 10-bagger. You're kind of chasing the momentum. So what I do, and the other two areas are your developer and your production plays. And there's different risk levels on those. And I've found that on developer side of things is that you get where the risk, I thought it was going to be easy, because it's not that difficult to spot potential 10-baggers. But what bites you is share dilution as those developer plays get played out, because in order to develop a project, it costs a lot of money to do your drilling, your development costs, your PEA, your pre-feasibility, and your permitting. It costs a lot of money to do that. So inevitably, there's a lot of dilution that goes into play. And so you're waiting for them to get to construction. So usually you invest early on these development plays long before they're in production. Sometimes you can get closer 1 to 2 years, but usually it's 3 years plus when you're getting in cheap. And what happens is, before they get to production, the share price doesn't appreciate tremendously. In rare cases they do, because you're waiting for them to get closer to production, and you're really waiting for them to get the cash flow going. So what happens inevitably in these is they get taken out. I've had, numerous stocks have gotten taken out, development plays at, 30% average premiums. And what happens is that a lot of times you're underwater, because there's been so much dilution between when you bought the share and then during the. So development plays, when you're going after 10-baggers, it's tough, because you might see 10 development plays, and of those 10, at least half of them will get taken out. And it's painful when they get taken out. And so what I have found is that the best way to find 10-baggers is try to find production companies, like mid-tier producers who have upside potential and growth. And you try to buy them when they're under duress, when they dip. And you basically try to get a good entry price on a strong company. For instance, back in 2011, when we had duress, when we had all those sell-offs, you said you wanted me to give some examples. And I bought First Majestic. It fell all the way to $1.15 during the duress. And that's when you really get easy 10-baggers. Those are the best risk reward. A couple other, Silvercorp, I got it down near $1, Fortuna under $1. And I waited, and you have to be patient. Another one that was under duress was Alexco. I actually bought it at 33 cents. And so when you're looking for 5 and 10-baggers, you have to be very patient.
Let me just interrupt you to clarify, because you said 2011, but I think you meant late 2008.
Oh yes, yes I did. I meant 2008.
I knew you meant 2008. I'm sure most of the audience, but I just wanted to clarify that in case a few
Yeah,
listeners were getting confused. But I'll just say, actually, I don't know if it was the first 10 bagger I had, but I did go huge into First Majestic. I bought that 3 or 4 times at the same time you did, and yeah, that was a 10 bagger. So,
yeah.
and actually, yeah, I invested in a couple of those other things that you mentioned, coming off the '08 low, But with that said, Don, where we are here and now, isn't it going to be more difficult to find a producer that could go up 10x? Just because we're not, gold's been off the low for 3 years and we're a year off of the late 2018 low. Isn't it going to? I mean, I'm sure you could still probably find a producer or two, but the pickings, I guess, are probably slim at this point if you're looking at that group. Or do you disagree with me?
No, I agree with you. We're getting there. We're definitely approaching it. So yeah, I have in the GSD database, Gold Stock database, there's 56 top picks. And I have, of those 56, I have a top 25 list. And so 25 of the 56 are in the top 25. Those 56 are all potential five baggers or higher. Actually, I think it's 52 of them. 4 of them are not. But so we're still there. But you said producers. So on the producer list, yeah, I think there's only on those 50, there's only 12, I believe, that are mid-tier producers, kind of 10 bagger potential. So yeah, the producers are starting to shrink, but they're still out there. But the risk goes up a little bit. For instance, some of those, like El Dorado Gold, the risks are higher on these. They're the ones that are going to be, they look like they're kind of highly likely 10 baggers still. I mean, at higher gold prices. I have Leah Gold Mining, Argonaut, Hummingbird. So there's still a few producers out there. Yes, they definitely have risk, because if you're going to think, if you're going to get a 10 bagger, you're definitely going to take on some risk at this time. We're not down. For instance, when the HUI was at 150, at that point, there was like a lot of choices, right? Now we're up to, I think, 215. But even at 215, a lot of five baggers, definitely. But yeah, the 10 baggers, they're not so. So you have to analyze these stocks and look at which ones have production growth potential. So you have to, and then kind of have to read between the lines. There are some 10 baggers out there, but it's hard to know exactly which ones. So you have to, like you said, you have to look at the 3 to 5 baggers, the really good ones, and see which ones become 10 baggers. For instance, myself, right now in my portfolio, I have 8 highly likely 10 baggers, and I expect to get 20 is my expectation. Now, when I say 20, I mean with gold going over 2,000. So I would.
Yeah, I just to interrupt just for clarity. So what gold price are you talking about? These producers being 10 baggers. Are you looking at 2,500 or 3,000 or 2,000?
Yeah, it's a good one. I focus on 2,500, but anything above 2,000 is really going to start moving these stocks tremendously. But yeah, the number I use is 2,500 because I just think that 2,000 is kind of an inevitable number. And I think it's a little bit too conservative. So yeah, I value companies at $2,500 gold. And that was another thing I wanted to talk about. So I have 56 top picks. Now, how do I do that? How do I come up with my top picks? My top picks are all based on future gold prices using future reserves and future cost versus compared to current market cap. So basically what I do is I take a current market cap and then I compare it to a future market cap. And the future market cap is based on future cost for individual companies, future reserves or what I expect them to produce, and then the future gold price. And I compare those two, and that's how I come up with my potential five baggers. And that's how I've done it from day one. And so I'm always projecting out into the future. So I'm basically a long-term investor. You said you're at 18 months. I'm more of a whenever it's going to happen kind of thing. So we could have a breakout of gold over the next 18 months where it could go to 2,000. So it's hard to predict when it's going to occur. but I don't expect it to happen in 6 months.
Also, let's talk about exploration because it sounds like you're mostly focused on producers and optionality plays. But if you look at producers, as I'm sure you know, Don, Kirkland Lake and some others, exploration success has been huge for those producers. And so it's I'm sure you probably agree, but exploration is such a wild card in this sector, and even just pure exploration plays. I mean, they're a gamble, but as you know, you can get 10 baggers that way. But so how do you assess the impact that exploration could have on an exploration company or a producer, or do you just not really factor that in?
Oh, absolutely. I factored in. So yeah, so what you're doing when you look at these producers that are like 3 to 5 baggers, you look at their properties and you look at how much exploration potential they have. And those are the kind of the stocks you want to own. For instance, like I Am Gold, I've always been a believer, well, not always, but for the last at least year, I've been kind of a believer in I Am Gold because of their exploration potential. They have a good management team and they have a lot of really good properties. So I consider them a growth story. So I'm looking for quality producers with quality projects that have exploration stories. So yeah, I definitely look at that. But you said I like optionality plays. I actually do not. So optionality plays for me are very rare. I think Chesapeake Gold is like the only optionality play that I kind of like. But by and large, that was kind of a lesson I learned that optionality plays are tough. But I do like development stories that look like optionality plays, if that makes sense. In other words, development stories that have really quality projects that are kind of long term. I believe in looking at companies that have what I call flagship properties. So a flagship property is something that would be in production like 10 years plus. 2 million ounce project, gold project, 40 million. So I'm always looking for flagship projects in good locations, and they kind of check all the boxes. The grade's okay, the economics are good, the location's all right, management. They check the boxes. That's what I'm looking for. Now to go back to exploration plays per se, early on, I was kind of an optionality play on exploration projects, and I did do project generators early on in my career because I thought that these companies knew what they were doing and they could find projects, and I found most of the time they can't. And so I still own a lot of exploration play, and I still do chase some drill results. For instance, I bought High Gold last week because they had and I'm chasing the drill results with them because I think that they are onto something in Alaska, and they also have some. They're drilling also in good places in Canada, Ontario, and Quebec. So I do buy a few exploration plays. The Golden Triangle, I own a few exploration plays there, but I'm kind of like Eric Sprott. I wanted to use an example of him kind of on how strategies goes for 10 baggers. Now, Eric Sprott has always been a guy that's after 10 baggers. He's like me. He doesn't care about a 1 or a 2 bagger. And he invests in a lot of exploration plays. More than me. I like to chase cash flow more than exploration plays. I think I saw on CEO, they show where he has 80 projects that they know of, 80 companies that they know of that he owns. And the majority of them are exploration plays. And he does exceedingly well. So I definitely think that exploration plays should kind of be part of your portfolio if you have a large portfolio and you own a lot. Now, Sprott, he's a billionaire, right? So if you say, let's take $1 billion, 1% of that is 10 million. And if he's investing in an exploration play, it's less than 1% of his cost basis, right? So my cost basis, I generally have less than 1%. And for exploration plays, I'm less than 0.5%. So you just have to keep your cost basis low so that when you go out and you go after these lottery picks, and you're trying to chase some of these, that you just keep your cost basis down. You don't want to put 1-2% in an exploration play. You can do it with a stop loss, of course, but I just think that's just too much risk.
Yeah, Sprott has almost single-handedly kept the junior industry alive in the last couple of years with all of his investments. And I will say it's funny that you mentioned the project generators because I'm going to do a video on those at some point. I don't want to say they're a scam, but a lot of people have lost a lot of money in those stocks in recent years. And they for the most part, they don't have any gold. Like they're really just, why don't you talk about expound a little bit on your experience with those and how you feel about those now?
Oh, in hindsight, I wish I would have never bought any project generators, and I would have just focused on chasing drill results and momentum plays, because I bought a lot of project generators that, like you said, that didn't have anything, and I would just, okay, I'll just wait. They have all these great properties. And they're going to find something, and they, like I said, they never do, and then they just dilute their shares into the ground, and you just end up, losing 80%, 80%. The stocks go down to 80% pretty quickly, and it's amazing how many there are. I mean, I have 800 stocks in my database, and the vast majority of them are exploration plays that don't have anything really. So when I say anything, I mean, they don't have a project that they're drilling. So what you want, if you're going to do an exploration play, is you want a company like, say, Lion Gold, who's onto something. I call it a drilling story. If a company doesn't have a drilling story, meaning that they're onto a potential discovery, a potential, significant discovery, and you don't want a project that maxes out at 500,000 ounces of gold, that's not going to make you any money. There's two things that you want to make sure that you do. One is you get enough exposure in that company that if they are a 10-bagger, or if they do find something, you make money back. I was talking to somebody recently who owned Silvercrest Mining, and I thought, wow, you must have $100,000 in silver, because he said he's like a 100-bagger because he got in early on Silvercrest. I thought, wow, you got 100,000 in there, and he said he only had 30,000. So he didn't even invest $1,000 in the stock. So if you don't have any, you got to invest enough so that if you do get that lottery pick, you make some money. $500, in an exploration play, that's probably not, enough. Because that's my feeling. You got to have a little bit of skin in the game in these, but you don't want to have a huge cost basis either. But again, you want to make sure that it's a good drilling story, meaning that they have good drill results already. So, I mean, something significant. Now, Lion Gold, I mean, that's not definitely a slam dunk. It's still a risk play. Quentin Henney thinks that there's gold deeper because they never drilled it deeper, and they think it's going to be a big mine. So it's a drilling story. It's a risk. I'm chasing it. I'm chasing high gold again. There's some new one. There's another one out right now that had a couple other drilling stories that I didn't buy Vizsla, but I'm looking at it. I mean, there's some noise about it. Maybe it's a good drilling story. Benchmark Metals is another drilling story people are talking about. There's a few others out there. But the best one, I mean, Bear Creek. I mean, once Bear Creek had those solid drill results early and then it doubled and tripled, I mean, that's when you get in. And those are the drilling stories you chase. Those are kind of 10-bagger momentum plays, and you can definitely make money doing it. But that's not my forte. I dabble in those. My forte is quality management teams, quality producers, and let those guys go to town and let them be very successful companies. And that's where you make your money.
Well, I like what you said about exploration and drill plays, because something that I look for, and you were kind of hitting on this, is I look for they found something, there's some value there, so there's some backstop as far as value, but they feel that there's a significant amount of potential that they can really expand what they've already found, and it can blossom into some huge discovery. So those are that's what I like to look for in exploration companies, where at least there's some kind of backstop, because the problem with many of them is they're just starting out and there's we like this project, but there's no backstop. I mean, they could drill it and not have good results, and then you're just kind of, it doesn't mean they can't hit onto it in the future, but then you're just kind of stuck onto the stock and you can't really sell it. And so I like to avoid those types of situations. But I mean, there is a lot more reward in those situations, because it's more ground floor than if you wait for at least a little something to be shown at first. So that's kind of my forte with exploration plays.
Yeah. Hey, people should be listening to us because we've been doing this for a while and we've learned that. And I agree with you completely. You shouldn't be investing in an exploration play that does not have a good drilling story. And the other point that you made, which I think is really, really good, is that you want, in tandem with the drilling story, you want to kind of listen to the management team and see how excited they are. And you want them to tell you the geology. You want them to tell you, okay, we found this drilling hole. This is what we found. But we know, based on the geology, that we have all these other drill areas that should also have gold-bearing mineralization. And they should be super excited about the drilling play. There's another one, I think it's in Senegal, that I'm actually looking at right now. And the management team is super excited about it. Oh, gosh.
Is it on the ASX or is it on the TSX?
Yeah, it's on the ASX. There's not that many exploration companies in Senegal.
Let me just stop you for a second because it might be, I can't recall what the first interview we did with a mining book guy, it might be the stock that he mentioned.
Yeah, it was him.
Is it Chesser Resources?
Yeah, Chesser, yeah.
He's going to be over the moon to hear it kind of shout out on this episode.
Yeah, so management is, so what I did, he mentioned Chesser, and I decided, okay, let me go listen to what management has to say. And management's excited about the stock, but it's an early play, and you have to wait and see, what the drilling were. It might be too early. Maybe wait and see if they can hit another couple holes. But one of the things, it's a big property, and that's a good example. So they've had some solid holes, and management is excited. And that's what my point was. What you said is that you kind of want a management team that is telling you what the story is. It's like, okay, this is what we've found, and we think it's going to be a big mine, basically. Those are the drilling stories you kind of want to chase, but they don't always pan out. But it's better than investing in a company that doesn't have a drilling story, and all they're doing is trying to get you to invest in their company. They're saying they're going to find something. We're drilling over here, but we don't, they don't have a mind that they're actually drilling. They don't have a story per se. But that was kind of my follow-up to what you said about you want to know that the company itself is kind of telling you what they think they have. And Lion One's another one that's kind of screaming, we think we have a big mine.
Right. Well, one other thing, I know you touched on this a little bit, but like what kind of criteria is most important to you? Is it, and I'll just throw off a bunch of things here. Is it management track record? Is it the track record of the geologists? Is it the share structure? Is it just the value of the company versus what it has and the potential? Is it the retail float? Is it their capital structure? How much cash do they have? Those sorts of things. Obviously all those things are important, but to you, are there one or two of those things that really stand out? Or is it kind of all of them together?
It's a good question. So I actually have an incomplete chapter in my book about this, and it's kind of how you value the company. And so what I do is when I start out, I look at the various areas and I try to identify the red flags. And so you start and there's various categories, right? So you start with the property, and the property itself. It's like, okay, is the property already a large mine? What are the resources they currently has? What is the grade? Is the grade economic? And it likes a combination of everything, but you're trying to find where the weaknesses are. What is the IRR? If the IRR is under 20%, you're like, oh gosh, it better be a pretty big mine, and it better be very, very cheap. There's some instances where you do that. It's kind of more of an optionality play, but you're kind of looking at, you want an after-tax IRR that's like 25% or higher. So the grade isn't super significant as long as the IR is solid. But you look at the properties, you look at where the property's at, the location, sometimes, there's certain places you just avoid. I'm more and more avoiding certain areas. For instance, in Africa, I try to stay in West Africa, even though the risk is getting higher and higher. Canada's my favorite. Australia's next. USA is third. Brazil, Ghana are probably after that. Then South America. Some parts of Asia and Russia and Russia and Europe I don't particularly like. So that's the location thing. Then if after that you look at the management team, have they done it before? I don't like it when there's an accountant who's the CEO and he's got a development project, because there's no way that an accountant's going to build a mine. I prefer people that have built mines already. I don't particularly like when a CEO has sold his last two projects. So you start looking at the red flags. You look at the management potential red flags, all the way down the list. Then the most important factor, and this is kind of what you asked me about, what is the most important thing you do? And the most important factor to me is future cash flow potential. So versus their current valuation. So if you look at a company, for instance, I learned very early on that you want to buy gold in the ground or silver in the ground cheap. So you want to buy gold in the ground approximately $50 an ounce versus their resources, what they're going to produce. They talk about, what are your values, your reserves. For instance, Kirkland Lake currently is valued about $1,500 per ounce of reserves. So that's kind of the upper band where you're going to get to. But a lot of companies are going to be valued, especially majors, at $500 for reserves, and some are going to be at $1,000. So if you can buy at $50, then you just need to get to $500. Or if you buy at $20, you only need to get to $200. So you want to buy around 50 or 20. So you're buying that low valuation. So for me, what I look at first, because if the company's only at 250% upside potential, then I probably am not going to be buying that stock. So that's kind of the most important number. But if it's over, say, 400%, then I'll take a close look at the red flags. And if it's over, say, 1,000%, I might accept a few more red flags. So in each of those different various characteristics of a company, those are the red flags, and you have to kind of weigh it all out. And then once in a while, you find a company that doesn't have any red flags, and you just have to buy it. I always say there's certain companies you have to have in your portfolio, and hopefully you got them with a good entry price. And so that's my answer.
Right. Well, before we end this, Don, and before you give out your website and how people can subscribe and get your book, I know you've mentioned some names already. Would you be willing to share maybe one pick for a 10-bagger? It doesn't have to be your best one, but one you're willing to give away.
Yeah, I'll actually do better than that. I'll give out 10. So for producers, I have Eldorado Gold. These are all potential 10-baggers. Eldorado Gold, Leah Gold Mining, Argonaut Gold, and Hummingbird Resources. Those are the producers that I think are potential 10-baggers. And for development plays, these are all late-stage development. Orezone Gold, Amarillo Gold, Almaden Minerals, Golden Minerals, Falco Resources, and First Mining Gold. So there's your 10 that people can go and take a look at.
Okay, Don, before I let you go, please give out your website again. Tell our listeners how they can subscribe and how also can they get your book. Okay,
great. So my website is goldstockdata.com. And if you send me an email, if you go there, you can click on the Contact Me. And if you've never tried it before, I'll give you a 2-week free trial. All I need is your email, and I'll set you up. That's kind of a Christmas gift for you. On my website, if you become a member, the PDF version, the digital version is free. Otherwise, on my website, there's a link on the very bottom that says book. You just click on the book, and that'll take you over to Amazon, and you'll see a lot of 4-star reviews on it. My book will teach you how to invest in junior mining stocks. And it's probably the only book out there that does. So, and Jordan, thanks for having me on.
Oh, it's my pleasure, Don. And the cost to subscribe is?
It's $150 a year. And it's a great bargain because one of the things that's fabulous about it is maintaining your portfolio. So what I do is you can actually put your portfolio on the website, and then you can monitor it. It'll have the current cost, and then you can go basically anytime something happens to your company or your stock, it has all the links right there. Without that feature alone is probably worth it. But then you get my my newsletter, which is free with your subscription, which is great because I have all these lists, 25 bagger list, 10 bagger list, dividend stocks in the top 25. So the newsletter is probably worth the subscription alone. So come on over.
Outstanding. Well, Don, it was a real pleasure to have you on. I mean, I was writing down some notes as you were talking because you provided us and our listeners with so much value. Listeners, you got to subscribe. I mean, we're setting up, at least in my opinion, for a really good 2020 for this sector. You got to subscribe to some high quality research. Go to goldstockdata.com. It's definitely worth it. Don, thank you so much for coming on. I really enjoyed our conversation, and I hope I can have you back again sometime next year. We can talk more about 10 baggers.
Yeah, let's do it again. Thanks for having me on.
Thank you for listening to the 10 Bagger Podcast, presented by the Daily Gold. For premium coverage of precious metals and the best junior mining companies, visit thedailygold.com/premium.